welcome to the Global Market Outlook for August 2022. The global markets have rallied. So since the last time we sat, which was sort of the beginning of July, things are looking pretty dire. And we've had a significant recovery in equity markets and just sentiment across the board. But I think the question I want to ask today is, like, should we believe it? Is this a true bear market rally? It's been very, very aggressive. One of the, I suppose, features of a bear market rally is that they are very aggressive. They go up very, very quickly, and then they collapse. It's, people call them a dead cat bounce as well. So I think today what we're going to try and explore is this market actually dead? Does the price level that we're seeing in equity markets at the moment warrant the pessimism, I suppose, that has been baked into the prices? We're going to look at the economics. We're going to look at the underlying equity markets themselves. We're going to look at commodities, which are always incredibly important because they form the inputs to so many of the products and services that we use. It's always, when we as focused as we are on inflation as we are at the moment, getting a sense of where commodity prices are at any one stage is absolutely key to trying to make a forecast and work out what's going on in the world. Of course, we'll look at the currency market as well. We'll go through a couple of the currency pairs, just look at some of the technicals, look at some of the fundamental drivers of the currencies as well. Then we're going to look at the global managed portfolio, but I've got a couple of investment ideas. We chatted about some NASDAQ notes last month. I've got maybe a couple of tweaks to those NASDAQ notes now, which I will share with you. Before we really get started, who are we? If you're new to the call and you've never joined a RandSwiss presentation before, you don't know who RandSwiss is, maybe you saw us on the social media feeds and thought, hey, let's go and listen to that guy. What do? We're a diversified financial services company. We specialize really in stockbroking, but we've got growing wealth division as well. Primarily, we focus, from the stockbroking point of view, online trading. That's where you guys go and do it yourself. You kind of, log in, you trade your own stocks. We supply you a platform. We try and give you as much of this kind of one-to-many content as possible. So we give you webinars, we give you training, your training webinars. There's little videos all over the place. We do supply, different levels of research as well, which I'll chat about in a bit. Then we've got private broking. Now that's a little bit different. It's more the old school high touch stockbroking. It's where you've got a dealer that you're speaking to probably every day, depending on whenever you want to make a call on the thing. It's a much more interactive experience. Often it's tied into a wealth manager as well. So a wealth manager will look at your holistic kind of like investment portfolio. It might not just be about your underlying stocks and equity positions. You might be looking at your bond exposure, your property, your alternatives. Maybe you've got a separate investment with private equity investment overseas that you need to kind of look at in the context of your overall investment. That's where our wealth management division comes in. It works very much hand in hand with the private client broking. Managed portfolios. Of course, that's where you give us money to manage, and we just manage it to a specific mandate. Like I said, the flagship portfolio is the global equity portfolio, which I'll be going through a little bit later on. But we've got all these little subsidiary portfolios that we run as well. And they're basically hand over discretion. It runs under our Cat 2 mandate. Structured products, that's headed up by Viv Govender at the moment. I'm going to talk about a couple of structures today, but they're normally credit notes. So it's looking at a slightly different asset class. You're not looking at the equity asset class. It's generally it's almost a hybrid because there's a little bit of derivatives in there, but there's also like the primary instrument underneath it is usually a bond or a bank credit note. You're taking on the I suppose the promise that the bank will pay you. Some very, very interesting things can be created. Some real garbage out there in the market in structured products, but if you've got a good team that can price them properly, we've had some absolutely stellar successes with the structured notes over the last couple of years. I don't think we've had one note that's ended negatively since we started doing structured notes 5 years ago, and some really incredible market beating gains, but I'll chat about that under the investment ideas at the end of the webinar. Offshore transfers, that's a little subsidiary thing that we do. We tie it all together. A lot of our client base is working internationally at the moment. So it just helps us, especially with exchange controls in South Africa. We've just tied up with basically a tax advisor as well, which is fantastic. So we're getting those foreign tax clearance certificates through in record time. It used to take 21 days. I think SARS is down to about 5 5 days, and we've got a dedicated resource helping our clients with that now. If you are looking to externalize funds offshore, and of course, we're super, super cheap on the whole thing as well. I mean, we don't have the overheads of the big banks, so we can make your offshore transfers incredibly cheap. And we also see it as a subs product. Our main business is wealth management and stockbroking and asset management and managed portfolios overseas. And it's just, this is something that just makes our lives easier when you kind of want to move something from a local jurisdiction to an offshore jurisdiction. We don't have to suddenly send your money to one of the big 4 banks where you're going to get absolutely ripped on your offshore transfer. And I think that's also about what Transfers does. It's about kind of like making all those little marginal improvements all over to your financial life. And that's kind of where we really add value to clients. I've already talked about wealth management service. Of course, one product that we are known for as well as our tax-free savings accounts. Fantastic little product. Who wants to pay tax in South Africa when you don't have to? And of course, you've got that 36,000 Rand allowance every year. We were actually rated the #1 tax-free savings provider in the country twice in a row. And that's run by Dan Fourie. And yeah, nice little subs product. We kind of believe it's something that every single client should have. If you're not contributing to one, you really should set one up. It's kind of like a no-brainer on the amount of benefit that you're going to get. There's also very few limitations on the fantastic little product. We kind of do it pro bono for existing clients. So it is only available if you have one of our other products as well, because we don't charge you anything on them. Basically, it's a total loss leading product. So that's who we are. Then obviously we've got all those logos up there. We work a lot in the media. We've got work a lot with the big international banks as well. We've got all sorts of platforms that we work with. So very, very, I think, a nice offering that we've built up over time. Intellidex and the Financial Mail agrees with that. We've twice been rated South Africa's top stockbroker, 2019 and 2021. As I said, top tax-free savings account provider 2 years in a row. We also won the People's Choice Award last year. So yeah, very, very proud of what the guys have done. I mean, we're a much, much smaller team than the big banks and the big listed brokers. So yeah, it's nice because we don't have the overhead, so we can keep our costs really, really reasonable. But it's also great that, thanks to your guys' support, that we've kind of been recognized, even though we're a much smaller house. This year, so just speaking of that as well, it is the Top Broker Awards again. So if you are a client, you do have to be a client to vote in this awards, or if you enjoy our content. I really would recommend going and filling in the awards. We will send around the link to the survey. Remember, these awards are done in 3 ways. Firstly, there's a client survey, so all our clients have to go and fill in. It takes about 15 minutes. It's a bit of a pain, but we really, really appreciate it if you could do it. I mean, we do all this content for you guys. And I really would appreciate it if you guys just go and click on that link, go and kind of chat to Intellidex about, kind of like your experience with Transfers and, what your profile is. They do ask some pretty personal questions, I've got to be honest. I don't like that. They do offer 10,000 Rand prize money for one lucky contestant. I think there's about 7,000 or 8,000 people that usually fill in the awards every year. So you work out your probabilities of winning there. Personally, to give over the kind of financial information that I'm doing, I don't put my name at the end of it. If I wouldn't put my name, should I say. If I was doing it, and you don't have to put your name, that your vote will still count, even if you do it anonymously. So we would really, really appreciate it if you do go and vote for us. As I said, last year we came top, and I mean, you can see the kind of guys that we're competing against. I mean, Standard Bank, or Standard Online Stockbroking, F&B, GT247, Easy Equity, Sasfin, all of those are listed companies, big banks. So for a small shop like us to do well, I'm very, very proud of what the guys have done. Just to kind of like also chat you through like what we've done over the last year. So thanks to, I think a lot, the exposure that these awards give us. I mean, we've managed to bring in guys like Anthony Clark to deliver research to some of our private client guys. And I mean, we're really happy with kind of the strides that we've made and we've been able to make thanks to the support of you guys as clients. So one, a thank you, and two, a humble request to go and fill in the Intellidex Top Stockbroker Survey. It does close on the 26th of August. So if you haven't filled it in, I think we sent out the announcement last night. If you haven't filled it in, please go and fill it in for us before the 26th. It would be really good. So with that as an introduction, Let's go and look at kind of headlines. We start normally with the headlines of what's happening in the world. And this is what we were chatting about. So it is a bit late in the month. I was actually away for 2 weeks. So it's a little bit late in the month. We normally try and do it just after the first non-farm payrolls print. And this was the introduction that I gave you. So that kind of paragraph at the top was the introduction that we gave you at the beginning of July. Global markets have continued to fall around inflation fears, rising interest rates, and slowing global growth. And slowing global growth spooks investors. The good news is that equity markets price in future events. That means equity markets are likely to turn long before you see positive economic headlines. The real question you should be asking is when and how best to position for recovery. Now, that's kind of what we were telling you last time in the depths of the depression. I mean, if you remember right, last month we were chatting about stage 6 load shedding. We weirdly had this like kind of counterbalance where China was doing very well. There was a big recovery in China. We had Jerome Powell basically saying he doesn't understand inflation anymore. I mean, there was real fear that the world was in proper trouble. What's happened in the last month? We've seen a total reversal of that in the call it month and a half. So you can see, one month ago we were sitting at basically at fear. We weren't quite in extreme fear. We were at extreme fear kind of a little bit earlier in the year. But I mean, there was a real sense of panic in markets that that inflation was runaway. We didn't know how to control inflation. Interest rates were going to rise aggressively. It was going to absolutely kill the economy. A recession was coming. It was going to be a deep recession. Unemployment was going to spike. Things were going to get really hairy. In response to that, we obviously had the equity market correction. Now we have the NASDAQ, which is obviously full of those growth stocks that don't pay dividends, and they've got a lot of future promise. And unfortunately, with higher interest rates, that just the way that you price those companies means that they are worth less when interest rates are higher. Rather get your interest now, and kind of we saw a big shift out of the growth stocks into value stocks. What's happened in the last month and a half is we've seen a huge reversal. So if you remember, we talked about those NASDAQ growth notes, and I kind of said, guys, like this is really an opportunity to look at some NASDAQ stuff. We are looking at launching a NASDAQ fund. So we are kind of bringing in, starting to build up NASDAQ based ideas. We do have some NASDAQ based ideas in the portfolio. I mean, we hold things like Google in the portfolio. We've, NVIDIA, we've got tech positions, certainly. But we wanted to do a focused tech position because, at almost 40% down, it did seem like a real opportunity. So as you can see, first headline that we're looking at, NASDAQ rallies more than 20% off recent lows as inflation fears ease. So as I said, the headlines, the best time to buy is when headlines are most pessimistic. It's the whole Warren Buffett, buy when others are fearful, be greedy when others are fearful, be fearful when others are greedy. So we've seen a big recovery in equity markets now, and you can see what that's done to the sentiment as well. As the equity prices have recovered, you've seen the fear and greed index, which this is based on the CNN fear and greed index. It essentially tracks it's a composite of all sorts of sentiment measures, things like the put call ratio, things like the VIX, and they make a kind of a composite index based on all of these underlying factors. If you're interested, you can find it on CNN Money's website. But it's a good track of just global sentiment and where we are. And you can see what's happened here. Over the last month, sentiment has just improved. We've now gone from kind of like extreme fear and fear, where we've been sitting for most of the first half of 2022. And we're actually at neutral. We're almost in greedy territory at the moment, which is absolutely incredible. So we've seen a big change in the way that people are thinking about financial markets. So why is that? So one is that inflation came in a little bit better than expected. And we had some very dovish comments from Jerome Powell about potentially maybe thinking about cutting interest rates. Also that he does not believe that the US is in a recession at the moment. We're going to talk a little bit about recessions and how you can tell if there's a recession and how you can tell if there isn't a recession. But yeah, like massive recovery. On top of that, we had a very strong payroll report. So we had a good non-farm payroll numbers. So the US labor market is still very robust. And then you kind of got this weird impact of the oil market as well. So there's a little bit of a fear, and this is what we're seeing is there's a fear, especially looking at the Chinese data that came out yesterday. There's a fear that China, after this big recovery, there are real problems starting to emerge, specifically in the Chinese property market. We've seen things like riots in China. Viv wrote a note and put it out on his weekly note, on his weekly podcast as well. Weird things happening in China at the moment, especially around their property market. Also, obviously, they're following that zero COVID policy with them kind of like easing COVID restrictions. We saw that big kick up in China, the month before, but we've seen that subsequently unwind. And there's a real fear that China is going to start to slow down significantly, to the extent that we've actually seen, China's got a lot of different rates and a lot of different levers that they can tweak their monetary policy, everything from triple R cuts to, like just tweaking all sorts of different lending rates. But now they've started to stimulate the economy because I think they're very concerned about slowing growth. They're also looking at keeping interest rates lower because they obviously have this kind of property issue at the moment. So what that has kind of led to is the idea that even though they're stimulating, there's going to be a real slowdown in China. I mean, we've seen GDP forecasts, being dropped by big banks for Chinese growth, across the board. And what that's done is actually pull down oil prices. Now, China obviously just such a juggernaut of a country, but just so non-correlated to what's happening in the rest of the world. So with China starting to slow down a little bit, you've actually got oil prices starting to subside because, they're one of the biggest consumers of oil, if not the biggest consumer of oil. And what that's done is it's obviously dropped oil prices slightly. So oil prices have moderated, and that is very, very good for inflation. So suddenly expectations around high inflation in developed markets have kind of tended to moderate, which means that we're not going to have to hike interest rates as aggressively. And suddenly everyone just got excited about markets. They're like, wait a minute, oil prices are low, inflation looks like it's coming down, just on the initial print, and we'll have a look at the prints in a second. Hey, we've got a kind of quite a dovish Fed chairman. Maybe these interest rate hikes aren't going to be as aggressive as expected, and it just sparked a massive rally. So that's kind of where we're sitting at the moment. What we are seeing, and I've just put that in as well, emerging market hit by a record streak of withdrawals by foreign investors. That doesn't include South Africa, by the way. So that's specifically focused on China. There's been a lot of institutional hedge fund money pulling out of China at the moment. So China has become a little bit less attractive as an investment destination. And what that's kind of created is this very a little frothy bear market rally, if you want to call it that. Now, the point is can we trust this? Is this suddenly going to collapse? And I think the question that we've got to be asking ourselves is, where does inflation go from here? Is it feasible that inflation can stay low? Are oil prices going to stay low? Let's look at all those inputs and try and come to a decision on where we are, because that's if you want to call it a snapshot of where we are at the moment. Now, just before we move on, kind of put this under headlines as well. This is something that one of the guys found and shared in the investment committee meeting that we have. And he said, this would be nice to put in a presentation. So I've put it in there. So also just with the idea that, yes, we've had a big correction in markets. We've had kind of a subsequent recovery, but this just kind of tells you as well is, I specifically want to look at the right-hand side of this chart for now. It's basically the time that the market spends in bear market territory. And you can see that, as an equity market investor, which I'm sure a lot of you guys are equity market investors, probably everyone on this call, just given the nature of the call. But as you can see, the time that the equity market actually spends in a bear market historically is very, very low. It's only about 29% of the time that we're in these kind of this correction territory. Most of the time, you actually feel pretty good about equity. So I think the reason I wanted to include this is the sentiment that we've been going through in the first half of the year. It is very unusual, that the kind of panic that people are feeling. It isn't the default setting in markets. So if you have just come in, let's say that you've never invested in equity markets, and in the last 2 years, you got caught up in the hype because people were buying AMC and, they were buying GameStop and Bitcoin was going berserk. And you were like, hey, I want to get involved in financial markets. And then suddenly you went from this kind of very frothy bull market to this very aggressive bear market, and you're going, wow, equities are terrible. I don't want to be involved in this stuff. This stuff is the devil. you shouldn't feel like that. That isn't the standard way that equity markets behave. You can see the vast majority of the time, equity markets, about 35% of the time, equity markets are actually at the all-time. 71% of the time, you're actually in a bull market. This is just based on historical data. 35% of the time, you're actually hovering at all-time highs. So the idea that there's always going to be a correction, it's something that we feel a lot in retail markets. Clients, when you're at all-time highs, clients are always coming to you. There's going to be a correction. There's going to be a big correction. Remember, about a third of the time, you should be at all-time highs. About the other third of the time, you kind of just having a little correction. So if you're a betting person and you want to kind of bet on the direction of equity markets, and you want to bet whether it's going to be a buy the dip situation, or it's going to be a protracted bad destroy all your cash bear market, the sensible thing is to stay invested. It's to stay invested long term, and it's to deploy capital. Obviously, in bear markets, that's a great opportunity. But even in bull markets, when you see a little correction, that's when you deploy a little bit more money. Now, we have moved into a bear market, which is defined as a 20% drop from high. So NASDAQ went into a deep bear market. We still, and we'll look at where the markets are sitting exactly in a second, but this kind of third of the time that we're in a bear market really is the best time to be deploying money. It's the time, I think a lot of people did deploy money, because we've been doing a lot of implementations, which is excellent, because we've been getting fantastic prices for clients. And I think I've said it to so many clients that I've spoken to over the phone. Every implementation I'm doing at these levels for clients, implementing into portfolios, buying equities, I'm just thinking, geez, when you come back in 5 years, you're going to have the most amazing experience compared to the guys that were kind of getting really excited in the bull market, going, we want to chase Bitcoin and GameStop and the meme stonks, as they call them. So, for me, a great time to deploy. We are off the lows, but still potentially a good time to deploy. If you've got a long-term time horizon, even deploying now after the rally, I think you'll be okay. On the left-hand side is just, it's basically the bull-bear spread. So it takes the percentage of investors that are bullish versus bearish and kind of subtracts them so that you can see, are there more bearish people than bullish people, kind of based on a survey. And you can see this, so on the left-hand column, the orange column, that's kind of where the bull-bear spread was. And then on the right-hand side was S&P returns over the next 12 months. So you can also see, and this is something that, in periods of pessimism, if you invest, and it's just intuitive, this should be intuitive. When markets are low, you should go and buy. You shouldn't be selling when markets are low. That should be kind of obvious until you're in it. When you've deployed a significant portion of capital and suddenly you're going into a bear market, then you start to get worried. It's a totally different experience. It's like playing poker for matches means nothing, but when you're suddenly playing poker for real money, the emotions change, your whole style will change, the way that you play poker will change. And that's why I think I wanted to put this up as well, is that when you've gone through, when you go into these periods of heavy pessimism, and we have been in one right now, we're in a bear market, there is high pessimism. The next 12-month returns are usually well above average. So you normally get these kind of kickbacks, and you get kind of the normalization, and you can make incredible returns when you deploy capital in these periods. And you can see here, in the most pessimistic time, 26% return over the last month. Remember, the S&P 500 does about 8% a year on average. That's what you can expect. Kind of like March 6, 2009, which is basically, that was if you had picked the bottom in the global financial crisis crash, your next 12 months, you would have made 67%. I went through that. I remember that. It was all about, everyone, they say a bull market climbs the wall of worry. Everyone was telling me, it's going to be is it going to be a V-shaped recovery or a W-shaped recovery? It's going to be a W-shaped recovery. We're going up, but it's going to fall again. We're going up, but it's going to fall again. And I think you've just got to kind of bear that in mind as well. Like that's always how it feels when a market starts to turn again. It feels like it can never go back to all-time highs. Look at all the problems in the world. It can't go back to all-time highs. Yet historically, just based on a statistical analysis, it does. Every now and again it doesn't. So you've got these are global financial crisis. They say, I heard Pietri Redlinghuis saying it on Simon Brown's show this morning. He says, being, I can't remember what he said. He said, being late, being early is the same as being wrong. And you can see that in 2008. If you were buying in January 2008 versus versus kind of that March 6, 2009, I mean, you can see the difference. I mean, you still had another 36% down. There could still be a real leg down here. But if you push that over 2 or 3 years, once you've had like a significant correction, I think you'll see that, the returns are very, very good. So this is obviously only over 12 months, but it doesn't always work, but you can see the vast majority of the time it does. Okay, sorry, I'm spending way too much time on this. Okay, so let's look at equity markets. Let's look at what happened over the last month. So after the kind of trying to, I think, talk everyone down from the ledge last month, I mean, it kind of all panned out. You can see just how good. I mean, almost a 30% rally in Amazon over the last month. I mean, absolutely incredible. Google, Microsoft, all of those stocks that everyone said, oh, you can't buy tech stocks anymore. You can't buy anything to do with growth. You've got to go into value. The segments that kind of didn't perform as well are the value segments. So you can see kind of the consumer staples under a little bit more pressure. Healthcare actually the only segment of the market in the US that was negative. But we still see energy prices rising, which, that is kind of, I suppose, the canary in the coal mine. But that's one thing that's got me a little bit concerned, is just these energy prices over here. I mean, but pretty much everything recovering. I mean, you can see it across the board, big recovery. If we go and look at the globe as well, so we don't just look at the US, we go and look at everywhere else, you can see a reversal in China. So last time we looked at the global map, it was only China that was green, and now it's only China that was red. So as I said to you last time, China is not something that I would go, definitely, there are real cracks that form in the Chinese economy. The Chinese economy is not the US economy. You don't go and put 90% of your money in China and 10% in the US because you're looking for spectacular gains. But China is an important diversifying factor. So I still believe that China has a place in investment portfolios. Even with all the issues and kind of when you get a sell-off in China like this maybe is a time to start deploying, because there's real, as I said, there's real concerns about what's going on in China, and their markets haven't performed well. I do get the sense that as a diversifying factor, it's quite non-correlated, or even negatively correlated, if you want to put it that way. It's almost, at the moment, it's not non-correlated, it's negatively correlated. So, as China, as the US falls, China has risen. As the US and the developed markets, and the rest of the world rises, China has fallen. So there's kind of that little counterbalance. So if you're looking to reduce volatility in a portfolio, building up a Chinese position might not be a bad idea. So everything pretty much recovering. And you can see also, even now, remember this is actually SASL, SSL is SASL, they're using the ADR tickers. So obviously that moving up, our gold mine is also doing well, but generally our market also, outperforming because of its commodity bias. So what's happening in so what's happening with the pandemic and the volatility index and the S&P 500, what all happened? Okay, so you can see I always leave kind of pandemic volatility there just to put it in context of where the VIX is. The VIX is another measure of kind of, they call it the fear and greed index, but it's another measure of, I suppose it's another sentiment measure to give you an idea. And you can see the VIX has been running, persistently higher than it did pre-pandemic. But it is starting to moderate. Remember, pre-pandemic, we were kind of sitting between 12 and 15 on the VIX. It couldn't break out of that range. But the oscillation has become quite wide. You can't really draw trend lines like this on the VIX. It's more an oscillator like that. And you can see, I mean, like I said to you last month, I mean, you can put a trend line there, but it's probably not going to hold because you're mainly looking just for that oscillation. We're down to 19. Are we going down to 15? Quite potentially. If we go to 15, we'll probably break this decline resistance level, the decline resistance line over here, and then maybe we will go to all-time highs. At the moment, though, the purple line is the S&P 500. You can see as volatility is reduced, obviously the S&P 500 has increased, and you can see there is kind of like just 2-point trend line. I do get the sense that we are going to go into a period where we start to test the validity of this bear market rally. We're almost at a critical point now. Either this is going to hold and we're going to go back, and then I think we're in for another kind of like little roller coaster dip. It'll be that double dip recovery, or we break that, and then I don't see what's going to stop us from going to all-time highs. So we need to look at the economics next. But you can see kind of a widening, kind of very, very volatile. They're not a steady downward trend, just real volatility happening in the S&P 500. But yeah, that's kind of where we are in the S&P 500. Big recovery, but I think getting to key tech, like I haven't got a technical chart of the S&P 500 other than this one. So just bear in mind that we are getting to kind of a critical level. So for me right now, I think things have settled down. It's helped to strengthen our currency. I would say now is probably a nice time to use the stronger currency to exit a little bit of cash. We're going to talk about it on the currencies as well. But S&P is at high levels. I probably wouldn't be deploying new capital today. Maybe not in the next week or so. Let's wait for that trend line to see if that decline resistance line holds. If that holds and we do get like a little bit of a sell-off deeper, then we'll start implementing again. Of course, if we break that, you'll probably get a break, a consolidation. It'll test the channel, and that'll be your new entry point. So I do think we're at very critical levels on the S&P 500, specifically just from a technical point of view. There's a deeper technical chart, but I'm not looking at that one today. It's just kind of like a base thing. But yeah, it's there was your bear market. And like I said, remember, most of the time markets sit at their all-time highs, a third of the time. A third of the time they're in these little bull market corrections, and every now and again, 29% of the time you get these big corrections, and those are the opportunities to go out and buy. So let's have a look at the economic. Okay, so we're going to have a look at the economic indicators. Economic indicators. Okay, U.S. inflation. So this is kind of the same story. Just now you can actually see a picture of it. What happened, remember, I mean, US inflation has been running hotter than everyone expected. Jerome Powell kind of threw up his hands and said, I don't know what's going on with inflation anymore. I'm learning how little I know about inflation, which is a terrifying comment from the head of the US central bank. But you can see everyone was expecting last month 8.8 as the expected inflation print. We've actually got two figures since our last meeting. Since our last webinar, it came in at 9.1. So everyone panicked. That's the end. Inflation has run away. We can't, like, inflation cannot be controlled. The only way to control inflation is aggressive rate hikes. We've got to kill the economy. We've got to spike it. We've got to get unemployment up. We've got to cool down the economy. Basically, this isn't going to be transitory. Oil prices are high. Just everything is running too hot. This isn't a supply shock working through the economy, if you want to put it that way. It's just all doomed. That was kind of the sentiment. Then it kind of started to unwind. So we got some rate hikes. And then we saw moderation in commodity prices, and suddenly things didn't look so bad. I think some of the supply chains are adjusting as well. I mean, we talked about it, how China is picking up oil from Russia as well. And you're just seeing a kind of a remapping of global supply chains and global trade patterns as well. And remember, an economy is a very dynamic, very chaotic beast, if you want to put it that way. But it's very, very adaptive as well. So it's very difficult to predict how it's going to react to different kinds of shocks. I mean, we've got all sorts of models that you can test, and you can kind of put different supply shocks, and you can see how that would impact portfolios. You've got all those tools, but ultimately it's going to be very, very difficult. I mean, they're just models. A model, I mean, I don't know if you guys have worked with models or gone on modeling courses and etc. But models, I mean, they're maps. It's not going to do everything perfectly. It's just giving you a guide. It's a rough guide, and they don't always work. So, and quite often financial models break down as well. So this is what was expected. Everyone panicked. And then what happened is we expected on SA inflation now, back to US inflation. Then we were expecting 8.7, we got 8.5. So not only did we have a kind of a quite dovish comments coming out of the US central bank, we also had inflation printing a little bit better. Like I said, we had a very, very strong unemployment print in the US as well, which is kind of, 3.5%. I mean, people used to think 4% was frictional unemployment. What is frictional unemployment? Frictional unemployment is the natural level of unemployment in a system, because people do become unemployed. They resign from a job because they're looking for another job, or, things happen in life that you suddenly are not employed, and then you go there. And in any economy, there should be this natural level of unemployment, and that's called the frictional level of unemployment. Everyone thought that was at 4%. We now have 3.5% unemployment in the US again, which is why we are actually not in a recession, which is interesting for me, and I wanted to, and that's why I want to explore this a little bit as well. So obviously, what is a recession? And it's a good question, because they call it a technical recession. I always say technically a recession is 2 quarters of negative growth, which we have. So since our last meeting as well, we've had another negative quarter of growth in the US. So we are technically in a recession. It is a technical recession because journalists, economists, they say when you have 2 quarters of negative growth, that's a recession, which means the US is in recession. So I kind of had a look at this and said, okay, but is the US in recession? Because it doesn't feel like the US is in recession. Yes, we've got equity markets lower. Yes, you've got rising, but you've also got rising interest rates. Recessions normally have cutting interest rates because growth has collapsed. So growth is collapsing to such an extent, and then it's, but it's stagflation. But the problem with the stagflation argument is that, yes, okay, growth is stagnating. Yes, you've got high inflation, but it's this labor market that's the problem. Like, the labor market is so strong. So how do you actually define a recession in the US? So the recession is the National Bureau of Economic Research, which is a non-profit organization. They actually get to decide when the US is in recession and when the US is not in recession. And what they say is, and this is how the National Bureau of Economic Research defines a recession. It is a significant decline in economic activity spread across the real economy, lasting more than 2 quarters, which is the technical aspect of the recession, which is 6 months. So we've had the 2 quarters of negative growth. That's fine. But is it a significant decline? I mean, we've had, that's 0.9% is not a significant decline. It's normally visible in real gross domestic product, GDP, which is what we're looking at, here, real income. Now, the problem is we've seen, yes, real income was falling in the US, but real income has actually increased in the US now. So real GDP, real income, unemployment, industrial production, and wholesale retail sales. So it's not as simple as just saying, we've got 2 quarters of negative growth, now we're in a recession. And I think that the thing that's really, and Jerome Powell has come out and talked about it as well. He said, with the labor market at 3.5%, you can't be in the US economy can't be in a recession if your labor market is this strong. It can't be in a recession. Like, it's not a recessionary, it's just not recessionary conditions. So his exact quote are, there are too many areas of the economy that are performing too well. It doesn't make sense that the economy would be in a recession with this kind of thing happening. That's from Jerome Powell. That is the kind of one of the very dovish statements that I suppose helped to spur the big market rally. But that's kind of where we're sitting at the moment. Like, growth is slowing in the US, but the labor market is just too strong. Federal funds rate obviously going up aggressively, and I've kind of given you quite a long-term thing just to show how fast interest rates are rising in the US at the moment, and obviously that is prompting the market to have to adjust fairly quickly. Okay, so let's move on to South Africa quick. South Africa, okay, not a lot of new data since we last spoke. So unemployment rate, which is a quarterly number for us, we only look at it every 3 months, still sitting at 34.5%, dismal, and we're not looking good at all, but we are not in recession. We're not in a technical recession. So we've still got economic growth. Our inflation is picking up, as you can see in the top left-hand quadrant. We expected 6.2, we got 6.5 the previous month. We expected 7.2, we got 7.4. So we are a little bit ahead of the curve in terms of where our inflation rate is. That said, the South African Reserve Bank does seem to be front-loading our interest rate hikes. So they have been fairly aggressive on hiking interest rates. You can see it what repo rate up to 5.5%. And I think that should kill our inflation. Well, let's hope it kills our inflation. It certainly has helped to protect the currency a little bit as well. But remember, our issues in South Africa are structural, they're educational. Changing the price of money, which is essentially what you're doing when you're changing interest rates, it doesn't teach people maths and science. You know, it's not something that can fix like an educational deficit. You know, changing the, you know, if you don't have people that can come up with ideas and start businesses and become entrepreneurs, and you don't have that human capital and that talent available to you because, you know, your educational system is broken, making money cheap for people is not going to suddenly spur a big, you know, everyone listening, you know, building new companies and a huge amount of economic activity. It'll spur consumption, which will spur, you know, a more indebted population. And if savings equal investment, that's going to be very bad for the country. So I think that it's definitely the right move to hike interest rates in South Africa. Personally, I don't think that the impact on growth is going to be as severe as it would be in a developed market. It's and the benefit, I think, outweighs the negative. Although from a market point of view, like obviously we want low interest rates so that our markets will go up. But in South Africa, I think it is a little bit of a different situation just because of our history and because of the structural issues that we are facing. Okay, so let's go and have a look at commodity markets. Commodity markets at the moment, so we've actually seen a stabilization. So after that big fall in commodity prices that we discussed last meeting, we've seen kind of a moderation this month as well. So this is just a composite index. It's the Bloomberg Commodity Index, the Refinitiv Core Commodity Index as well in orange. You can see they track each other. They're kind of competing indices, if you want to put it that way. But yeah, so you've seen kind of a moderation. There has actually been a slight increase over the last month, but you know, kind of those dramatic increases that we saw in the beginning of the year, thanks to the supply chain disruptions, etc., you know, not playing out. Now, you know, obviously we have to look at the underlying, you know, each underlying commodity, so and where it came from. So we had bulletin reporting results today. I mean, you can see energy prices, coal prices specifically, shooting the lights out, helping to lift things, you know, from a commodity point of view. But the commodities are very diverse, and it really depends on inputs. So that's why we're going to look at all of them. So what's happened to oil? So oil's kind of continued its downward track. You know, it's moving. We did get you know, some lift in OPEC output, but OPEC output certainly, I think, disappointed the market overall. I think everyone is hoping for a little bit more supply to come online. That said, obviously there is the potential for Iranian supply to pick up if the Iranian deal is struck, and if Iranian output comes back onto the global market, that will do a lot, I think, to shore up some of the supply deficit that we're seeing. At the same time, with the kind of poorer figures coming out of China, as I've already said, that has helped to just you know, kind of suppress oil prices down to kind of that, you know, if you're looking at Brent crude oil, that was down at about $94–95 a barrel. If you follow this webinar and this meeting, you know that my view is that oil should be sitting between probably 65, 70 and $80 to $90 a barrel. That for me is the range that, you know, a cartel, which is, you know, it's not even a cartel, it's basically a Saudi Arabia-led cartel, maximizes profit because they've got to obviously maximize, you know, their price. They're basically, you know, a monopoly pricer. So they don't want oil prices just higher at any cost, because you will see a switch to substitute products. You've obviously got the green energy revolution happening. If oil prices go to $300 a barrel, it just accelerates the move to alternative energies, and it makes all the oil that is under there, you know, under the ground, you know, less likely to make profits in future. You know, the whole idea of peak oil. So I think it's kind of a moderation at the moment. Like I said, with kind of you know, Russian output being moved into China and India, you know, it kind of makes sense for me that oil prices come down. I've still seen lots of forecasts from the big banks saying that oil could still potentially spike to $250 a barrel. It's very, very possible. For me, I kind of feel that OPEC wants it in that range. If China really is slowing down, that's going to kind of pull commodity prices down a little bit lower as well. And I mean, certainly, like, oil price will come down. It will kind of solve the inflation problem. So it really depends on what your outlook is from an economic point of view. What is going to happen with the economy going forward? Because I can tell you, with oil prices, you know, kind of oil prices continuing to track lower like that, that's going to alleviate some of the pressure on those inflation numbers. That's going to mean that less rate hikes, and that's going to be very, very positive for equity markets. Soft commodity markets, what's happening here? So you can see that the softs, we've seen a little bit of recovery, and some of that would have been feeding into those headline indices that we talked about earlier. You can see specifically some coffee futures getting a little bit more expensive, sugar, orange juice. So kind of, unfortunately, your breakfasts are getting more expensive. If you have coffee and orange juice with breakfast, then it's going to be more expensive for you. And you will all feel that. But generally, you know, like the Japanese rubber, cocoa, you know, nothing specifically dramatic in the soft commodity performances. You can see the power complex. This obviously, I mean, there's headlines all over the world, you know, people saying that they can't keep their families on life support because, you know, or at least they can't feed themselves because they have to pay for the power to keep, you know, family members on life support. I mean, the kind of pressure that Europe and the UK is feeling around, you know, the higher energy prices is incredible. Obviously, we're going into European winter in the next couple of months, where it's going to be even more crucial from a heating point of view. And yeah, this is a real concern around European. I think European exposure and European households. I think, you know, the consumer-facing stocks in Europe, I think, are going to be hit, because I think budgets are going to be very, very tight. And unless we see kind of a proper resolution coming in, you know, between Ukraine and Russia, yeah, I think this is, yeah, I struggle to see where it's going to come from. I mean, I did a whole presentation on the oil majors recently. Like it was like kind of an energy webinar, and it wasn't recently, it was probably about a year ago. And you can just see that there isn't enough capex in the system to kind of do what needs to be done. Now, this again, I think it's going to prompt a move towards renewables. There's almost no question about that. So something like Ørsted, I still think is a very, very interesting company to go look at. It's a Danish wind company. So I think you've just got to be careful. You know, maybe the consumer discretionary stocks, you know, in Europe, be a little bit more circumspect. You've also got super taxes on the UK oil companies to help, you know, the government kind of almost mitigate the impact on UK citizens. So there's a lot moving in the energy markets, and it's moving a lot of things. So I think Europe, I'm kind of a little bit more cautious of at the moment, just around the rising energy prices. Grain and oil seeds. So if you look at the wheat and kind of like, you know, we also did a whole piece on palm oil recently as well. But you can see a little bit of a moderation there. I mean, soft commodity, you know, specifically the grain prices have been coming down. And also over the last month since we last spoke, no big spikes, no big changes there. Still elevated, but hopefully people plant and prices normalize. As we go forward and the economy adapts to the big shock that it's gone through. Okay, next, I don't normally look at this one, but I've put it up as well. I've got one in front of it for you. But so these are basically the precious metals. So precious metals, you can see, haven't done particularly well. So I mean, other than like the base minerals, like things, you know, they've done a little bit better. But you know, this is gold, which is XAU, platinum, which is XPT, and silver, which is XAG. You can see this is a year-to-date chart. So I've done this chart very well for you guys. But yeah, year-to-date, the performance has been pretty poor. So all the gold bugs are out there, unfortunately, with all the chaos and all the thing that the gold, you know, in dollar terms hasn't done particularly well. Now, the reason for that has been the strong dollar. Remember, all three of these commodities are priced in US dollars. So when you have a big flood of money going into US dollars and treasuries specifically, because you can kind of get an interest rate, suddenly gold and silver and these precious metals become a little bit less attractive. We talked about that. I've talked about that at length. You know, the idea of an investment based purely on scarcity versus an investment that is based both on scarcity and the ability to produce a return, like a bond, which will give you a coupon, or a stock, which will give you a dividend. Very different investment opportunities. I still like gold as a diversifying factor in portfolios, or if you're really concerned, I mean, in South Africa, it's a little bit different. You know, you can go and buy a couple of Kruger and stick them in your pocket. They work as fantastic, you know, rand hedges as well. So if you think your currency is going to fall apart, or you think the country is going to be put onto the grey list, and you know your bank accounts are going to be frozen, it's a catastrophic hedge. You know, it's one hedge above whiskey and gunpowder when things really fall apart for the zombie apocalypse. That's why you own gold. You know, as a kind of a long-term retirement asset or like the bulk of a portfolio, you would never, again, it's like almost like China. It's a diversifying thing to have in your portfolio, maybe 5 to 10% of a portfolio. It's not something that you go and put 90% of your money in. That would just be crazy. But, well, in my opinion, I'm sure a lot of gold bugs on the call are going, shut up, Gary. I think it's fantastic. But yeah, that's kind of, performance of precious metals. So let's go look at the currency markets quickly. Okay, so this is the currency update that we normally do on Rand dollar. So I think we got a call pretty well last time. As I said, we were taking, me and Krista were taking derivative contracts above 17. We thought that there was going to be a moderation. We just thought it had been oversold. If you look at the technicals here, you can see that, really when we spoke last time was beginning of July. So it was kind of, I think we were hovering, it was 1560. So we were kind of just up that channel there. And we we're kind of heading to that top incline channel. That's where we were. We had already drawn this one up, and I literally haven't. The only extra line that I've put on from last month is that little kind of like decline line that we're seeing here with the strengthening Rand. But yeah, so it kind of went straight up, tested the channel top, where, if you're a trader or if you, for some reason, bringing money back into the country, which we seem to do a fair amount of as well, that would have been the point to bring currency back in. That's where we put on our trades. We've now out of the trades as we approach the bottom of that. I think I exited at about 1620. I closed my short on the Rand dollar pair. And now I'm just sitting kind of like wondering where it's going from here. And I think it's an interesting picture that we're looking at. So, we've had a brief weakening over the last couple of days out to, I think it's 1646 at the moment, but it's 1643 when I did this chart last night. And as you can see, well, this morning, I don't know when I did it, but you're back at the bottom of that channel. So for me, it's like, again, it's almost we're sitting at a critical point. Like the whole market is sitting at a very, like, it's almost at an inflection point. And it's kind of September, which is, we're getting towards the time where overseas traders come back into the market. So I think we're going to get a very good sense of the direction of the market in the next, say, month or so. But either we're going to break this is a very, very steep decline resistance line there. Either we're going to break that, and then I think we're going to head a lot weaker. I can easily see that playing out. That's if China, if China does slow down significantly, if we get an unwind, you remember that S&P 500 chart hitting that trend line, if we suddenly get another leg down in equity markets, you get a little bit of fear moving in. Remember, we've gone from extreme fear to neutral. If we go back to kind of like a very pessimistic market with commodity prices falling, remember the Rand is very, very correlated to commodity prices. If that happens, easily see the Rand push out. Your level would be kind of first would be this long-term level there around 1750, and could potentially push out all the way up to 1850 as well. I see that as very, very possible. But difficult to say because, like, I mean, it would keep the existing channel on track. I can that scenario. I can see. I mean, if I had to guess, I'd probably say. I'd say give it like a 55% chance that happens, 60, maybe 60% chance that happens. Like I think that is pretty likely if we look at again, but that's a very pessimistic view, and I think I started so optimistic on if we go to all-time highs on the S&P 500, then we will probably see more currency strength. You'll probably see. I still don't know. Last month we talked about the commodity clock. Where are we in the commodity clock? I kind of said, like, I'm in for falling commodity prices. The one problem with that is that there hasn't been significant investment in new capacity at a lot of the major miners. And the problem with that is that you aren't going to get this big glut of, they kind of don't seem to be making the same mistake as they've made in the past. And if that's the case, you might see commodity prices staying high for a little bit longer. And if we don't see another leg down in commodity prices, you're probably not going to see the Rand going up to there. Instead, you'll probably see this trend line break. And then, like I said, like maybe this like short-term declining trend actually holds, and then we go stronger. Then we go all the way to 1550. We'll probably go to this green line down there, and then you've got the bottom of the long-term channel down at kind of like 1540 as a potential exit. For me, I don't know. I don't know. I get the sense. For me, I think the traders, and we'll look at the bank and brokers estimates now, but I think the traders I would probably be using now, and it was very difficult because I normally put the range that I would suggest that you exit cash if you're looking to build up international exposure, which is a lot of private clients are doing that. It was either between 15 and 15.30 or 16 and 16.30, and I wasn't sure whether to be a little bit more aggressive on taking funds out. I suppose that's it. If you're a little bit more aggressive, if you've got the view that you want to deploy and that you want to get in at good equity prices, I think 16.30 is probably not a bad level. You know, the trade could work like this. We go out, it's called it like 16.20, 16.30. You get out, you externalize your currency, you give it a little bit of time. You see a little bit of panic coming into the market. The fear, you know, that fear and greed index goes back down into the fear section. Markets start falling off that S&P 500 trend line. Suddenly you've taken money out. This will spike to the top of this channel. The technicals basically are telling me to do this. If I just look at the technical picture, I would say that is the most likely thing to happen. That will move back up to the top of that trend line there, and you'll be sitting with, like, let's say, dollars overseas with a weak equity market ready to deploy into. Fantastic. You're going to get amazing things. You're going to come back in 5 years and you're going to be one of the heroes of the 2022 stock market crash, because you would have bought at amazing levels. There's that scenario. The other scenario is that, hey, things aren't that bad. Like, that US labor market is fine. We're not going to get, let's say, inflation starts to moderate because oil prices, because China is subsiding a little bit. That's the other scenario. I don't know if that's it. I mean, for me, there's not enough data points. I mean, we looked at that. Like, we have a hawkish Fed, I mean, at least a dovish Fed governor. We've had subsequent Fed speeches that have been far more hawkish as well. And we've got a market that's quite excited about a strong labor market print and a beat in expectations on inflation coming down a little bit quicker than expected. For me, that's one data point. There's not enough economic data there. I think, you know, if we get a weak CPI number next month, or like this month at least, or the next CPI number that comes out, if that's weak and we suddenly see inflation in the US going back to above 9%, this will play out. Equity markets overseas will collapse. Rand will spike. You will have taken your money out. You'll be ready to deploy into weak equity markets overseas. Everything great. That's probably my I'll give it like 60% because I'm not sure. The other scenario is that we break this trend line and we start developing a new trend going down to about 1550. That would require commodity prices to stay fairly high. I can see why commodity prices will stay high, but I mean, listen, you look at the profit these companies are making. How long are they going to be able to not increase output? I mean, it takes a long time to increase output, and they haven't spent the money yet. So yeah, I think probably 60-40, like that we're going to break it. I think we're going to head back. The trend is your friend. I'm going to go with the trend. I think we're going to weaken from here. There's my head on the block. If we look at what the big banks and brokers are saying, we can see all of them have become a lot more pessimistic. You can see Standard Chartered, I mean, previously were one of the most optimistic banks on the Rand dollar pair, 1440, has moved to 1543. Just about everyone. Standard Bank, 1521 out to 1571. Goldman Sachs, remember what they were printing? They put that 1280 in a couple of months ago. Goldman Sachs was at 1450. They've moved up to 16 Rand to the dollar as their 12-month target. Investec from 1565 to 1635. So the banks are definitely agreeing that we're going to go into this little weakening trend here as well. And that when I say that, the bank economists, that is. Morgan Stanley from 1480, their reprint up to 1714. They're looking at a significant weakness in the South African currency as well. This is over the next year. So they, you know, conservative estimates, but again, it just gives you a sense that move, that shift towards pessimism for the Rand dollar. So pessimism for the Rand, optimism for the dollar. You can see both the median estimate of the 23 analysts that were polled and the smarter estimate, both now in the 16s versus kind of mid to high 15s last time we looked at it. So yet, since we last looked at it, when it was 1661, it's actually gotten stronger. And that's why, like, I'm kind of shifting my view from hold on currency to saying, yeah, I would probably take some cash out here. Maybe not all of it in case you do get the strengthening down into the 15s, but yeah, there's some interesting things. There's some interesting opportunities overseas that I could easily see that we'll get a good deployment into. What's happening on the dollar index? Maybe you're thinking, how much stronger can the dollar get? You know, we had dollar index. Remember, it's a basket. It's an index that represents a basket of the 6 major trading partners of the US, and it gives you a sense of the dollar, not just versus the rand or versus the pound or versus the euro. It's just what's happening with the dollar. So I've given you kind of a long-term chart all the way back to 1985. Last time we had it like real inflation and high interest rates in the US. You can see the dollar index, the dollar could get a lot stronger if you look at history. This just because it's getting to just because for the last, say, since 2003, we haven't seen anything like this since kind of like early 2000 was the last time we were at this level. Doesn't mean it can't get a lot stronger as well. The dollar could get a lot stronger, especially if we see continued rate hikes and the labor market remaining strong enough for them to push through the rate hikes as well. So, yep, that's where the dollar index is at. If we just look at the euro and the cable, sorry, I just fixed this from last time as well. So we still almost at parity. So we haven't seen it, like over the last month, even though we've seen the market recovering, we haven't seen an unwind and a move back into Europe. But that's why I'm still a little bit concerned about Europe. I think we might be getting good equity prices there. I mean, like from a price index point of view, but certainly from like let's say an economic point of view, the markets are telling us that living is going to be tough in Europe at the moment. For those of you who are thinking of immigrating to Europe, life is going to be tough there. That's all I can say. Maybe don't immigrate just yet, but maybe just invest in the US, stay and live your best life in South Africa. Anyway, sorry, I'm not going to talk about that. But yeah, still almost at parity. So we're at 101 on the euro dollar, $1, €1, almost the same thing. Then we've got so pound as well. Pound also, like, I mean, you can see both of this is just dollar strength. I mean, the dollar has just strengthened against both the pound and the euro. So again, dollars has been where it's at. Dollars is it. So if we look then, so now we're just converting the pair to say pound. So I've got a question here. Okay, we'll come to that in a bit. Okay, so it's a long question. Okay, currency markets, pound ZAR. Okay, again, last time it was quite interesting. So we were about here. It was beginning of July last time. So we were sitting just on that kind of like middle fork of this channel that we've drawn on the pound. So again, I didn't change anything. I put an extra circle on the chart from last time and just added the extra data point. What happened on the pound dollar? We literally went up to touch that trend line that we had drawn from last time, then all the way down and touched the bottom trend line and have now moved up. So those trend lines were very good trend lines that I gave you guys. If you're looking for levels on currency, I seem to know what I'm talking about. This time around anyway. Currency will make us all look like fools, but yeah, so that's exactly where we kind of touched on the pound. Moving down again, we've kind of hit the bottom there. Like if I was going to go buy pounds with my rand and I was going to deploy into the UK, or you were moving to the UK, or you have UK, whatever reason you want to move money to the UK, I really like the optimal exit is at the bottom of this trend line, which isn't, it's 20 cents from where we are now. I think the risk is, again, I think a weakening of the rand up to probably 20, back towards kind of 21 rand to the pound, I think is the scenario, the chart is telling me. You can see both oversold, like if you just look at, like I've just made it a little bit more sensitive. I've changed this to a 7-day wilder. You can see this kind of consolidation period then moved into oversold. You saw the weakening there. We're back down at the bottom of the RSI at the moment. I think it's going to be a weakening. I don't know. Like I said, currency will make us look like idiots. I'll come back next time and this will be broken and we'll suddenly be at like 17 rand to the pound. Who knows? So what's happening on the euro? The euro chart I can't read. I think I said I can't read it last time either. RSI low, but not obeying the trend lines at all. It's broken out of this trend line totally. We had this kind of like very rough downward trend line that's kind of shifted a little bit. I think I talked about this circle here saying maybe we must look at the horizontal support there, but I can't read the euro at the moment. I mean, I'm finding it very, very difficult to get a pattern on the euro. It's just kind of hovering there, and Euro Rand is not something that's like really, I don't really have a technical view on it. That break there, I mean, maybe we will get stronger. It's the only indication that I've seen that we might see a stronger Rand, is this kind of little breakdown on the Euro as well. So what I did decide is, instead of going for 15 to 15.30, which I think is going to be optimistic, I would say 16 to 16.30, decent time to take currency out. It will get you ready for deployment if the markets do weaken again. Obviously, we work with Saxo and Swissquote to deploy funds internationally, both very, very good platforms. Thank you, everyone, for participating. Please remember to go and do that stockbroker survey for me. That's the one thing I will ask you to do. Please, if you enjoy our presentations, please go and give us a good ranking, and, or not give us good, give us a fair ranking, if I want to put it that way. Good ranking, please. But yeah, thank you everyone for attending. We'll do it again next month. Thanks.